When you need a new appliance, you want a great selection. So you're probably thinking big box store. But if you're shopping for luxury appliances, Bray beats big. We have the luxury brands not available at the box stores and the experts to answer all your questions. Visit the Fall Luxury Appliance Event to get free delivery and free basic installation on select Monogram wall ovens and cooktops. Plus, get up to 24 months special financing. Shop local at Bray and Scarf, where it doesn't cost more to get more.
If you're shopping while working, eating, or even listening to this podcast, then you know and love the thrill of a deal. But are you getting the deal and cash back? Rakuten shoppers do. They get the brands they love, savings, and cash back. And you can get it too. Start getting cash back at your favorite stores like Levi's, Plow and Hearth, Adidas, Sephora, and Neiman Marcus. Stack sales on top of cash back and feel what it's like to know you're maximizing the savings. And it's easy to use. And you get your cash back sent to you through PayPal or check. The idea is simple. Stores pay Rakuten for sending them shoppers, and Rakuten shares the money with you as cash back. Download the free Rakuten app or go to Rakuten.com to start saving today. It's the most rewarding way to shop. That's Rakuten. Rakuten.com.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Double announcement and double the cuts. The Bank of Canada and the U.S. Federal Reserve opting to cut interest rates on the same day this month, and it was the first of a few double meetings to come. Now, it's good news if you have a mortgage or if you owe money, but the picture is a bit murky going forward on both sides of the border. As of this moment, what comes next is hard to predict. I'm Kris McCusker, and in this episode of The Big Story, we speak to Randall Bartlett, Deputy Chief Economist at the Desjardins Group. So what are your takeaways from the Bank of Canada's latest announcement?
Yeah, my sense from the Bank of Canada's latest announcement is there are really, three reasons that the bank decided it was the right time to start cutting interest rates again. I mean, the first one is the weakness that we've seen in the Canadian economy, both in terms of overall economic activity. But since the second quarter, we've also seen a couple of months of weak labor market data. And so I think that helped, tip the balance of decision makers at last week's meeting. When we also look at underlying inflationary pressure, it looks like we're seeing some of it come off. So we're seeing less pressure on the price growth side of things, so that also helped. And then finally, since the July meeting of the Bank of Canada, we've seen the federal government remove retaliatory tariffs on about half of the goods imports from the U.S. that we had retaliatory tariffs on. And so that's going to bring down inflationary pressures going forward as well. So it's sort of a triple threat of weak economic activity, lower underlying inflationary pressures in the most recent data read, and then less underlying inflationary pressure going forward as well. So all of these, I think, worked to make the Bank of Canada's decision last week easier than it might have been otherwise.
Well, and it's interesting to me as well because, and please correct me if I'm wrong, but I read somewhere that something like 60% of mortgages in Canada are set to be renewed this year and next. So how much is a quarter point cut going to change the real estate market in this country, which is a big part of the Canadian economy?
I think any interest rate cut is going to be a positive for the real estate market in Canada. And so ultimately on net, it is going to provide a bit of a tailwind to households and to the real estate sector. When it comes to the renewals that are upcoming, we saw obviously a lot of mortgages taken out in 2020 and 2021. Those are up for renewal this year and next year as well. But we've seen households be very proactive in terms of making the lump sum payments that are going to be necessary if they have fixed payment variable rate mortgages or increasing their monthly payments in order to get ahead of that renewal and sort of minimize the impact that it's going to have on their household budgets. So we've seen households be very proactive. We've seen the savings rate in Canada continue to be very high. And so particularly among higher income households that are more likely to have mortgages. And so when we look at Bank of Canada surveys, that tells us that, that savings really is, focused among, concentrated among households that have mortgages, and it is to get ahead of that mortgage renewal. So we've seen households be very proactive, and we've also seen financial institutions to be more open to working with households than they might have been in the past. So certainly it is going to be something that's going to hold back growth. It's going to hold back consumption more than if we weren't contending with it. But the upcoming mortgage renewals aren't going to be the sort of the threat to overall economic growth that we might have thought they would be, a year ago or 2 years ago. But at the same time, bringing down rates always helps. And ultimately, as the Bank of Canada, we think is going to continue to lower rates through the end of this year, that's going to provide continued support for households in terms of contending with those upcoming mortgage renewals.
I guess it's really a question too, right? Like how much of the real estate story in Canada is playing out because of interest rates and how much is playing out because of uncertainty?
Yeah, uncertainty is playing a big role, we think, in holding back potential home buyers from entering the market or from moving up in the housing market. And so, we've seen, obviously, the labor markets weaken this year, particularly in July and August. And ultimately, that's contributed to keeping potential home buyers on the sidelines, even as we've seen that listings activity is picked up pretty significantly. And so now you look at some of Canada's most unaffordable markets, like Toronto and Vancouver, they're deeply in buyers' territory. And so there's really a real opportunity, we think, as we see uncertainty start to come off, we see interest rates coming down, that we could see a pickup in the Canadian housing market, a modest one, but a gradual grind higher in Canadian housing market activity through the end of this year and next, as we get some of that uncertainty coming off and the cost of borrowing starts to come down.
There's also this whole question about, the affordable housing argument. And we did have this housing announcement from the federal government. And then at the same time, housing starts are probably not doing what they should be in order to improve the affordable housing situation. How do you see that? I mean, again, a 25 basis point cut is going to make a slight difference, but not huge, although you've also said that there's likely to be more cuts. So I guess the affordable housing picture might be moving in the right direction. Is that fair, do you think?
Well, when we think about housing affordability, the way we measure it generally relates to market housing. So the cost of buying a home and servicing the mortgage of that home. But when we look at what's been happening in terms of the housing market recently, particularly housing starts, it hasn't been driven by market housing becoming coming down the pike. So thinking about the condos or detached homes, it's really been purpose-built rental accommodation that's really been where the starts activity has been. It's taken over the mantle from condos in terms of building activity. You look at presale activity in condos. I mean, it's hit record lows in Toronto and Vancouver. And so the condo market is really struggling in Canada's largest cities, but purpose-built rentals aren't. We've seen a lot more activity in that space. We've seen a lot more building in that space and a lot more building committed to coming down the pike as well. And so the federal government took measures to get rid of the HST on purpose-built construction. We've seen that the apartment construction loan program had significant take-up at CMHC, and so there's a lot of purpose-built rental coming on the market. So as we see that affordability is still strained across Canada in market housing in a lot of places, we're seeing the opposite now happening in the rental sector in Canada. So we're seeing that year over year market rents are in negative territory now, and we're seeing that when it comes to overall rents, that growth is continuing to cool, and so we're seeing that rent CPI year over year continues to slow. And so certainly in the rental space, we are seeing improved affordability. Not quite so much now in the market housing space, where there's still a fair bit of demand and sale prices are still fairly high compared to incomes. Now, when we put that in the context of the Build Canada homes, measures announced by the federal government. And that's intended to bring on more affordable market housing going forward, leveraging things like federal lands, providing financing for more affordable market housing. And it's intended to support the sort of modular home construction sector to increase the amount of housing that's becoming available, improve productivity in the construction sector, that sort of thing. But there are a lot of questions around, how effective that policy is going to be. We've seen that, similar policies elsewhere in the world, didn't actually meet the expectations that were set out, and how quickly even this could actually come online and provide that sort of affordable housing. So, big question marks around what the new federal government measures are really going to mean for housing in Canada. But certainly in the near term, we are seeing some improvement in affordability, and we think that that's probably going to continue into 2026.
Yeah, so more to come on that, most certainly. The other thing I'm interested in your take on, and this didn't get a lot of press when the Bank of Canada did the interest rate announcement, but the Bank of Canada governor did say he does not expect a recession. What are your thoughts?
Yeah, so the Bank of Canada is forecasting an increase in real GDP growth in the third quarter of 1% annualized. We just put out analysis today that is going to show that we're expecting real GDP growth to be positive in the third quarter as well. And so while it's not going to feel good when you get very weak growth in the third quarter of the year after a deep drop in growth in the second quarter, it is possibly going to be able to skip a recession. Now, it's tough to say. Data gets revised. We'll see how the data rolls out. But certainly a recession in Canada in 2025 is not yet a foregone conclusion in our view, and it seems to be the shared view of the Bank of Canada as well.
Well, and again, in the bank's, defense, the next interest rate announcement is October the 29th. The federal budget comes out a few days later, and the U.S.-Canada trade is still not solved to this point. So there are still many moving parts that could sort of change the path on interest rates.
Yeah, there are a lot of moving parts, as you say. There's a lot of uncertainty around what the economic outlook looks like going forward. I would say there are a few positives for the Canadian economy that maybe we didn't account for back in the spring or just didn't expect. I mean, one of which is the scrapping of the retaliatory tariffs. That's going to be positive for the Canadian economy, bringing down inflation and supporting the Bank of Canada cutting interest rates, but also by boosting economic growth by making things more affordable for Canadian consumers, for businesses. And so that's certainly going to be a positive and tailwind for Canada. Another one is the U.S. economy. It's been outperforming, I think, our expectations and those broadly of economic forecasters. And so the U.S. economy is showing a lot more resilience than we anticipated. And so even if we're constrained in how much we're trading with the U.S. because of these tariffs, U.S. economy is still doing fairly well, all things considered. So certainly that's going to be a tailwind to Canada. And then when it comes to trade with the U.S. and exports south of the border, the effective tariff rate, so the weighted average tariff rate that is paid on Canadian exports to the U.S. is only about 3%. And you look at the countries that the U.S. runs the largest trade deficits with, China's over 40% now. We've got a lot of Asian countries and some European countries closer to 20% in terms of the tariff that their goods are facing when they come into the U.S. Canada's closer to 3%. And so Canada has actually been spared some of the worst of the tariff measures introduced by the U.S. administration. And so ultimately, we think these things together are going to be supportive of maybe a more robust economic outlook than we anticipated back in the spring.
Now, you spoke about the U.S. economy, so let's move on to the Fed announcement. What were your takeaways there? I have thoughts, but you're the expert here. What were your thoughts after that announcement?
Well, the U.S. Federal Reserve is facing a different set of indicators than the Bank of Canada is. Now, the Bank of Canada has one mandate. That's targeting inflation, total inflation. And total inflation in Canada, we now expect will be below the Bank of Canada's 2% target in 2026 and 2027, even if it cuts rates a couple more times. the Fed has a dual mandate. So the Fed targets core inflation, and it also targets full employment, or the unemployment rate. And so it's trying to get core inflation to 2%, and it's trying to get the unemployment rate to full employment. Now, the challenge there is that core inflation is still elevated in the U.S. at around 2.5-3%, and the unemployment rate has been rising, and we've seen weakness in employment overall as we've had significant downward revisions to employment earlier in the year. Now, the Fed chose to focus on on employment and the labor market when it made its decision to cut interest rates. Financial markets priced in certainty of a rate cut in September, and the Fed rarely diverges from where markets want it to go. But I think it is going to be a challenging situation for the Fed going forward, because it seems like in some ways, even if the unemployment rates, ticked up a little bit, we've seen a little more weakness in the labor market, the unemployment rates are really low in the U.S. And so it could face potentially this challenge of its dual mandate, sort of indicating different things. And the Fed will have to try to strike a balance between those going forward as it makes its monetary policy decisions.
The other thing what stood out for me was two things stood out for me. A lot of politics now around the Fed, number one. And number two, it seems like they're not all on the same page.
Yeah, that's absolutely the case. I mean, the most recent appointment to the Federal Reserve Board of Stephen Miran, who's a member of the Council of Economic Advisors for the President of the United States. I mean, that his dissenting vote and dissenting views of where the path of interest rates should go going forward is sort of very much aligned with where the White House is, and really not where the rest of the voting members on the Federal Reserve Board are. Now, I would say, his views are probably not as aligned with the folks on the Federal Reserve Board, because they're focused on the economy. They're not focused on the demands of the White House. And so there has been a lot of politicizing of the Federal Reserve. And I think you saw what happened in the bond market not long after, where we saw longer term interest rates in the U.S. go up significantly. It is a reflection of the fact that, bond markets are not on side with the Federal Reserve cutting interest rates significantly and causing inflation to move higher as a consequence. And so ultimately, I think it was James Carville who said, if you're to be reincarnated, you want to come back as the bond market, because everyone will be afraid of you. The bond market will, I think, provide that signal to the White House and the Fed that, they may not be able to move as aggressively as some members would like, because of the fact that borrowing costs will rise significantly for the federal government in the U.S.
And it was, I sort of smiled as the U.S. Fed chair was taking questions, and there were a number of questions that he just did not want to go there.
No, absolutely. Absolutely. The Federal Reserve it should be independent, has been independent for some time, because there's always a political incentive for political leaders to want interest rates to be lower, because people like low interest rates, in spite of the fact that it may raise inflation, and people don't like inflation. So there's a real contradiction there. So ultimately, central banks, not just in the U.S. but in Canada and elsewhere in the world, were given policy independence so that they wouldn't be influenced by the politics of the day, because ultimately that's what led to the stagflationary environment of the 1960s, 70s, and early 80s. And so, there were a lot of lessons learned there that seem to have been forgotten in some areas of economic policymaking.
The other thing that's sort of noteworthy here is that this was the first time the Bank of Canada cut rates since March, but it was the first time this year for the Fed. What does that they were both on the same page at this latest meeting, but that divergence impacts our loonie, which is good for exporters, but bad for Canadian consumers if they're traveling south.
Well, it's certainly been, there's certainly been a lot of good news, arguably, for the Canadian dollar this year. Not if you're an exporter per se, but for Canadians, importing goods and hoping to offset some of the impact of those retaliatory tariffs. The Canadian dollar is up, 5% or better on the year against the U.S. dollar. And that's not just a reflection of monetary policy. In fact, we're seeing a divergence away from interest rate spreads being a big determinant of the value of the Canadian dollar against the greenback. And we expect that to persist going forward. What we're seeing instead is a broad depreciation of the U.S. dollar against all major currencies, and including, and maybe in particular, a lot of European countries where we've seen upwards of depreciation of the U.S. dollar of 10% or more against a lot of European currencies. And so that broadly reflects, in our view, and we've published research on this, that there's a lot less appetite for U.S. treasuries in particular, so U.S. government bonds. And we've seen a lot of outflow of international purchases of U.S. treasuries this year. A big part of that is the large deficits and debt that's being run and plans to be run by the federal government in the U.S. And so because of that, less demand for U.S. assets means less demand for U.S. dollars. And ultimately, that's caused the greenback to depreciate against those other currencies, including the Canadian dollar.
And you want to highlight something else.
So one area that was excluded from the Bank of Canada's press release and the governor's opening statement was a reference to the upcoming budget and the substantial expansion of federal spending that's anticipated going forward. Now, we've seen estimates as large as a deficit this year of $100 billion that which would put the federal deficit in 2025-26 at the largest level outside of the pandemic on record, as far as I know, and as a share of GDP among the largest outside of a recession or pandemic on record in Canada. And so one of the things that the bank's governor said is that they'll need to wait until they get the budget to know what the spending looks like, to feed it into their models, to see what the impacts would be on the Canadian economy and inflation. But ultimately, the next Bank of Canada interest rate decision is going to be just before the federal budget is tabled on November 4th. And so it's going to be a real challenge, I think, for the Bank of Canada to avoid having those conversations going forward because there is expected to be such a massive expansion of federal government spending. And that is going to have impacts on the economic outlook. In fact, we've revised up our outlook in part because of this substantial increase in federal spending that's planned. And it's also going to have material implications for inflation in Canada as well. There's an expectation that they want to build all of these new homes and start all of these infrastructure projects and massively expand defense spending in Canada at the time that we're constraining immigration into Canada. And so, we expect to see that it's going to have an inflationary impact by boosting demand for the inputs into building all of these things, the wiring, the lumber, all of these sorts of things, and also demand for labor. And so it'll put upward pressure on wages as well. And so, the Bank of Canada is going to have to take all of this into account. And I think they're going to have to twist themselves in some knots to try to avoid having that conversation at their October rate decision.
Well, and that leads nicely into my final question, and I'm not going to hold you to it because I know things can change between now and October the 29th. But if you had to bet today, we have interest rate announcements in Canada and the U.S. again on October the 29th. Do both banks cut?
Yeah, our expectation is that the Bank of Canada and the Federal Reserve will both cut interest rates again at the October rate decision.
And then...
Now, we expect the Fed to cut again in December, and that's certainly where market pricing is. So we think it's it's a pretty good spot to be in terms of a call, and we've been calling for this for some time. For the Bank of Canada, it'll be interesting to see how they account for the federal budget. I think that will be a deciding factor whether or not we get a third cut this year or a third cut before the end of the year in December. But we do think that if we don't get one in December, there's a good chance we'll get one in January. And so the Bank of Canada's policy rate will probably bottom out at around 2%.
I just want to highlight here, I'm having a look at the calendar. So both banks made their interest rate announcements on September the 17th. Both banks will make their interest rate announcements October 29th. both banks on December the 10th and both banks on January the 28th. So a lot of intrigue to come. You'd think that the two banks would talk to each other and maybe not do these on the same day.
I think the calendar's just fixed, unfortunately. So I don't know that they consult with each other before they do this. But the Bank of Canada is on a later schedule than it would be normally. Typically, it'd be a week earlier than the Fed. But it's been an unusual year in terms of timing.
It's interesting. It's very interesting. Thank you so much for taking the time to do this today. I appreciate you walking us through all of this. And I appreciate how thorough you were as well. So thank you.
No, my pleasure. Thanks so much for having me.
That's Randall Bartlett, Deputy Chief Economist at the Desjardins Group. Never a dull moment for economists these days. That wraps up this episode of The Big Story. You can find us on the Seeker app or on all of your favorite podcast players. Please rate, review, follow, and share. I'm Kris McCusker. Thanks for listening.